Hey guys, Michelle Kinney here. Thanks for checking in. Thanks for checking out my video. I'm going to do a quick video today on averaging down your cost on stock. So what I mean by that is, let's say you buy 100 shares of stock and you pay for those shares $100 per share. As the stock, or if the stock comes down, you might want to do one of a couple of different things, right? Some traders focus on cutting their losses, and they will institute a stop loss, what's called a stop loss. And they can put an order in, like a good till cancel order, when or if or when the stock comes down to some predetermined price, let's say $90, for example, they want to sell their shares. And the purpose of doing that is that they limit their loss, right? So they don't ride it all the way down, so to speak. They limit their loss to, let's say, $10 per share. So what that means is, a trader buys 100 shares of ABC stock at $100. He puts a stop loss in at $90. It goes to 90. It becomes a market order, and he sells his shares, let's say at $90, and he loses $10 per share. Now, an alternative to that is that you can buy more shares as the price comes down. And why would I want to do that? Well, here's why. If we focus on understanding the difference of paper gains and paper losses and realized gains and realized losses, when you actually sell your shares for less than what you paid for them, you recognize an actual loss. So it's an actual loss that hits your pocket, right? And what do stocks do most of the time? They go up and they go down. So many times. And hit me up with a comment on this video if you have experienced this before, where you put a stop loss in and the price goes down, you sell your shares only to see that stock go back up again right afterward. I can't tell you how many times I've experienced that myself. So you might think, is there another way? Is there a better way? Warren Buffett says that if a stock is great, so for example, if you buy ABC stock and you pay $100 per share and you think that's a great deal, if it's a great stock at $100 per share, it's still a great stock at $90 per share. It's an amazing stock at $80 per share, right? It's on sale. So an alternative to selling your shares, putting a stop loss in, selling your shares and taking an actual realized, recognized loss is to buy more if the price goes down and you're averaging down your cost. So I'm going to give you an easy mathematical way to understand that. Let's say I buy 100 shares of ABC stock at $100 per share, and it goes down to $90 per share. And if I buy another 100 shares at $90 per share, now I have 200 shares, right? I bought 100 at $100. I bought 100 at $90. My average becomes $95 per share. So I'm averaging down my cost. So that's an alternative to taking a recognized loss on the stock. So hope this helps. Hit me up in the comments if you've ever experienced putting a stop loss in, having that stock go down only to see it bounce way back up afterward. I've done that I've experienced that countless times. I hope you liked the video. I hope it's helpful. Happy trading. Please be sure to subscribe to my station here. I am committed to putting a new video every single day. I think I've been doing this every single day like clockwork for the past, 2-3 weeks now. Anyway, hope this helps. Happy trading.